We're going to do a short video on selling short, and stick with me to the very end, and we'll show you how to get these recommended short positions every day before 7 a.m. at no cost. We're logged into RBAMresearch.com, and this page shows you both long and shorts for a variety of instruments. Let's start up at the top, listing the holding periods. You can see they go from 1 to 20-day holding periods. That basically means if you were to buy today, you'd close out by end of the trading day tomorrow, and so forth. Buy today, close out at the end of the trading day on the 20th day, and the same with the rest of these. Basically, these prices expire on the day they're issued, so they're issued before 7 a.m. on the 27th. In this case, they're issued every trading day, and they would expire by the end of the trading day on the 27th. If you scoot down here real quick to where we list some shorts, you can see we're looking at the S&P 500. This is the futures contract, the E-mini futures contract, one of the most liquid futures contracts in the world. And you can see that every day we're going to list buy and short positions. Now it would be a buy or a short, and you can see today we have no buys, and they just list the shorts. These there's nothing here for the one-day hold, but the two-day hold has a short price to keep an eye on. These are prices that we recommend you take a look at. You got to always use your own judgment and never trust anybody or anything other than your own judgment. But these are really good reference points to keep an eye on every day to keep you straight in terms of your thinking and compare to your own analysis. This is a recommended short position to keep an eye on for the 27th of May, and it's 4,079. If the market hits that, you would short it. Now, selling short simply means selling something you don't own. So on the 27th, you would approach the market flat. You'd have no position in the S&P 500. If you wanted to short, you'd simply go to your trading station and sell the S&P 500 futures at 40.79 or greater. If it hit that price or greater, you'd sell it. You would then be short. You started flat, you sold something you didn't own, you're now short. So to cover that price, if it went down, you'd make a profit. So to cover it, you'd simply buy it at something below 4,079, say 4,075, you'd make a 4-point profit. If it went up and it got to the end of your 2-day hold period, you'd close it out at a loss. So you're going to close out regardless. Within 2 days, you take a profit as soon as you can get it. If you don't get a profit, you close it out at the end of the 2-day holding period. And again, you want to hold for longer periods, you can do that. These typically have higher win rates, and they also have slightly higher average profits. But again, in and out is almost always your best bet, especially if you're trading the S&P 500 futures. And the beautiful thing about trading shorts is shorts usually go down much faster than a market goes up. So if you learn to short, and it's not that difficult to learn to do it, if you learn to short, you can make profits very quickly in and out in much shorter times than if you'd have to wait for the market to slowly rally and back and fill as it does. You can take a look at any chart pretty much, and you can see that markets drop quickly and tend to go up fairly slowly. So if we keep an eye on these as we scroll down, we have the S&P 500 futures, we have crude oil futures, gold futures, treasury bond futures. These are your most liquid futures contracts, not all of them. We don't list a 10-year treasury note. It's one of the most liquid, but it doesn't have nearly the day trading range that a bond would have. We also list down here for shorts the interbank cash forex market. And you can see we have in this line here euro dollar versus the United States dollar, and it's recommending shorts to keep an eye on. Again, you have to use your own judgment, but all the way down the line you can see these different short positions. Same thing, you'd enter the market flat, and if you wanted to short it at this price, you would just enter it and hit the sell button, or however your broker has it rigged to do that. It's very straightforward, but the key is a short is you're selling something you do not own in the hopes or the expectation that it will go down, and you'll buy it at a lower price. That's shorting. It's just that simple. Now let's scoot back up here. Let me just show you the rest of this. We have the major currency pairs. We also have Bitcoin, and you can see same thing. We offer buy and shorts every day. Let's go back up here to stocks real quick and talk about shorting stocks. You'll notice our stocks are listed as buy onlys, and there's a very important reason for that. The stock market has a natural upward bias. That's just the way it is historically. It doesn't mean you can't short stocks. You can, but shorting stocks is a very tricky game. There's some structural reasons why you can get in real trouble shorting stocks. There's some technical reasons why you can get in real trouble shorting stocks. And many very successful, very smart people have gone broke shorting stocks. The reality of the situation is the safe way, in my opinion, and I don't make recommendations, but in my opinion, if I was going to do it, I would buy put options if I wanted to take a short position in a stock. Buying a put option gives you the option to control the stock, to sell it at a price. So for example, instead of buying here this Court Therapeutic at 1984, if you could buy a put option at 1984, you would have the right to sell it to somebody at 1984, even if the price dropped to say $15. So your maximum risk would be the cost of the option versus shorting Court and having unlimited risk that it might go up to $30 or $40 or $50 on you. Now, why don't you have the same kind of risk on the S&P 500 futures contract? Well, the reality of it is you have theoretically that risk, but there's a lot of other technical reasons that, in my opinion, shorting a futures or a currencies contract is much different technically than shorting a stock. Obviously, there are people who short stocks. There are short funds, there are hedge funds that do nothing but short. But for a normal investor without a tremendous amount of capital, I think it's much safer to short stocks by buying puts. That's just my opinion. You have to do what your judgment dictates. But in general, I think it's a much safer way to make a lot of money on stocks. You can definitely make a lot of money on stocks going down, but a safer way to do it, in my opinion, is to buy put options. Let's scroll down here to the bottom. All of these are updated every morning at 7 a.m. RBAMresearch.com. As I said, we cover 190 stocks for the buys if you're interested in those. Buys and shorts on forex and cryptos, and the most liquid futures pairs. No credit card required. You just sign up. You get free access. They're all updated by 7 a.m. every weekday. Keep in mind, everything you see here is for entertainment purposes only, and you definitely trade at your own risk. Consult a financial advisor if you need one, and you never enter a trade using anything you see on these pages as your sole judgment. You always must use your own judgment and your own ideas. These are just reference points and not specific entry points. If you like this video, please click the like button. If you want more, please subscribe. And again, RBAMresearch.com. Trade at your own risk, and all this is for entertainment purposes only.